Hello and welcome to this class on the lender of last resort function of central banks. The panic of 1907, the Great Depression, the global financial crisis of 2008. Banking panics and financial crises can have devastating impacts on the financial sector and ultimately the real economy. In this session, we will examine how a central bank, by providing short-term cash loans during a financial crisis, can help to stabilize financial markets and prevent the worst-case scenario. We will see how these interventions should be designed in principle, but also how they work in practice. We will also understand the potential costs of these interventions. We will examine these issues in the context of the 2008 financial crisis and the 2020 global pandemic. Let's get started. The idea that a government-backed central bank should intervene and stop a financial crisis dates back to Walter Burchett, a journalist from the 19th century England. In 1873, Burchett famously said that in times of financial crisis, central banks should lend freely to solvent depository institutions, yet only against sound collateral and at interest rates high enough to dissuade those borrowers that are not genuinely in need. This statement has become a touchstone for how central banks should respond to financial crises. Let's quickly unpack what it means. Let's start with central banks should lend freely to solvent depository institutions. Sometimes healthy banks are swept up in a banking panic. Since all banks borrow short and lend long, some of these healthy banks might run out of cash. This is who the central bank should support, the solvent banks. What about the second part? Against sound collateral and at interest rates high enough to dissuade those borrowers that are not genuinely in need. What does this achieve? First, the central bank should not lose money when it intervenes. These programs should not create losses for taxpayers. And second, borrowers should only tap the central bank when no other options are available. This should be a temporary support and not a long-term solution. The borrowers should want to pay back any central bank loans as soon as they can. Burchett thought the government should intervene, but do so with care. The ultimate goal is to stop the banking panic without losses to the taxpayer. That's the theory. Let's see how this works in practice. Let's consider central bank interventions in the two recent crises, the financial crisis of 2008 and the global pandemic of 2020. Let's begin with the 2008 episode. This was triggered by the contraction of the US housing market that began in 2006. The decline in house prices was accompanied by a rise in mortgage delinquencies. As losses mounted, there was a sharp reduction in credit supply, especially in short-term funding markets. This culminated with the collapse of Lehman Brothers, a well-known investment bank which sent shockwaves through global financial markets. By the fall of 2008, the US was on the brink of a deep recession. How did the Federal Reserve respond? Well, the first thing they did was to cut interest rates from 5 to 1/4% in mid-2007 to effectively 0%. In addition, the Federal Reserve set up a variety of emergency liquidity programs to stabilize financial institutions and credit markets. The Fed wanted to stop the panic after Lehman Brothers failed. This was the Fed acting as the lender of last resort. Traditionally, the Federal Reserve would have provided emergency cash loans to only banks through the discount window. However, in 2008, this was not going to work. Banks were no longer the only game in town. Non-banks played a crucial role in many funding markets, and many of these non-banks were swept up in the panic. For example, Lehman Brothers was an investment bank. It did not have access to the discount window. To stabilize funding markets, the Federal Reserve acted decisively by extending the reach of the discount window along 3 dimensions. First, longer-term funding dried up for banks, so the Federal Reserve established the Term Auction Facility, or TAF. Second, securitization markets had collapsed after the bankruptcy of Lehman Brothers, so the Federal Reserve established the Term Asset-Backed Securities Loan Facility, or TALF, to unfreeze this market. Participants in the TALF could get long-term loans directly from the Fed to buy securitized loans. Third, many non-banks that were central to funding markets desperately needed cash. The most important and reputable investment banks are also called primary dealers. Primary dealers serve as the trading counterparties for the Federal Reserve's open market operations. They are crucial for monetary policy. They are also vital for well-functioning treasury markets. The Primary Dealer Credit Facility, or PDCF, and Term Securities Lending Facility, or TSLF, were established to meet their needs. Money market funds were experiencing runs, so the Fed established the Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility, or AMLF. Finally, the Commercial Paper Funding Facility, or CPFF, provided support for US issuers of commercial paper. This is the only example of a direct purchase program in 2008. This meant that the Federal Reserve bought commercial paper outright. While this was mostly issued by financial institutions, the Fed did end up buying paper issued by non-financials such as Harley-Davidson or McDonald's. By historical standards, this was a highly unusual move. Okay, that was a large and complex intervention. Was it successful? Would Walter Bagehot be happy? Well, first and foremost, the Federal Reserve did stop the financial panic. And in each of these programs, the emergency loans were backed by high-quality collateral and above-market interest rates were charged. The loans were repaid quickly and the programs were wound down without any losses. On the other hand, this was a massive and unprecedented expansion of the government safety net. Many of the financial institutions receiving support were not depository institutions. They were not supervised or regulated by the Federal Reserve or another bank regulator. What if market participants continue to expect the Federal Reserve to offer support when things go bad? How will this affect risk-taking? There is no clear answer to this question. Let's fast forward to 2020. The global pandemic arrived in the US in the first quarter of 2020. By March 2020, there was severe volatility in the treasury market, which was likely to cause disruptions in short-term funding markets. This set off alarm bells around the world. Since the 2008 financial crisis showed how bad it can get, policymakers rushed to provide first support to the treasury market and then more broadly. As before, this included the Federal Reserve acting as the lender of last resort. While the shock was very different, we will see the central bank's response was similar. Several liquidity facilities used during the 2008 financial crisis were rolled out again, including the Term Asset-Backed Securities Loan Facility, TALF, the Commercial Paper Funding Facility, CPFF, and the Money Market Mutual Fund Liquidity Facility, MMLF. The perhaps largest program was the Paycheck Protection Program Liquidity Facility, or PPPLF. The Paycheck Protection Program was a government program providing 600 billion in forgivable loans to small businesses. Under the PPPLF, lenders could receive funding for these loans from the central bank. The direct purchase programs played a much bigger role this time around. The primary and secondary market corporate credit facilities, the P and the SMCCF, provided direct support to large businesses through the corporate bond market. The Fed was directly purchasing corporate bonds on a large scale. And by April 2020, the Federal Reserve was also involved in direct lending to small businesses. The Main Street Lending Program allowed the Fed to partner with banks to originate small business loans. Where does this leave us? What more can we learn about the lender of last resort from the 2020 episode? Well, let's start with the good news. First, these interventions look successful in avoiding a total meltdown of the economy. Second, we learned that crisis interventions seem to work best when fiscal and monetary policy work hand in hand. Perhaps the most successful government intervention was the Paycheck Protection Program. We can easily see why the Federal Reserve providing the 600 billion funding for these loans was crucial during a time of crisis. At this point, banks probably would have rather hoarded cash than make additional loans. How would Walter Bertschut feel about all of this? Well, he only thought central banks should support depository institutions. That seems to be a thing of the past. He was also concerned about potential losses to taxpayers. Well, unfortunately, going from 2008 to 2020, we saw a far greater involvement of the Federal Reserve in direct lending to small and large businesses. This, of course, means that the Federal Reserve is directly exposed to losses if defaults in the corporate sector were to occur. That would surely make Walter feel uneasy. Let's wrap up. What have we learned in this session? The lender of last resort can stop financial crisis through emergency lending programs. Historically, these funds flowed to banks, and loans required high-quality collateral and above-market interest rates. We saw how the Federal Reserve intervened to calm markets in 2008 and 2020. Finally, we discussed how the footprint of these emergency lending programs has expanded in recent years to cover non-banks as well as direct lending programs.